And we're live.
Alrighty.
Hello, everyone. This is Two Accountants, One Gap again. Coming back to you with, I guess, just another shallow dive into financial statements. My name's Andrew. I'm here with my co-host. I was trying to think of some kind of creative word, but we'll just go with co-host.
Yeah, close.
Bacon means.
Yep.
And yeah, so last week we covered just balance sheet, kind of how to go through it. Contrary to popular belief, that we don't need to get into today. I've seen some YouTubers that talk about looking at cash flow and balance sheets. If you've watched this, you know that's not a an actual thing that you see on balance sheets. So, moving forward, we'll talk about these statements of income today. Before we do that, happy Good Friday, Bacon.
Yes, happy Good Friday.
How's your day going, Bacon?
Going all right. Just had lunch, so ready to do some dives.
Nice.
Yeah.
Why did it not pull it up? Okay, so present, share screen. There we go.
Yep.
Okay. So,
are we able to zoom in some by chance?
Yes.
Like, I know it's not that much, but yeah, like that is one of the feedback that I've gotten. Feel free to leave comments on like how we can improve these things. Financial statements are limited on what we can do, but you know, yeah, try to make things a little bit better for the viewer.
Yeah. So here is, and one of the things we'll get into, but a lot of these statements of income, they are very, very, what's the word? Truncated, condensed,
yes,
consolidated.
yes.
A true state, like Alphabet's own internal statements of income, if they had it all broken out, would be massive. I mean, at my company, if you don't roll everything up, you're talking like 3 to 4 pages. I gotta imagine that Google's is. I mean, you have, because this is Google proper. This is GCP, right? Everything rolled up. So if you want to, Bacon, you can start going. We can just start at the top and kind of work our way down. We can go through what these mean.
Yep. All right. So top line or revenue or crudely sales. Again, that's what a lot of people care about. Like if you're more entrepreneurial, that's what drives the company is you want some sort of inflow of monies. But again, this is accounting though. As far as financial statements goes, so this isn't cash accounting. This is accrual based accounting. Revenue recognition. We recognize a revenue or sale, generally speaking, once that obligation has been met, hence the revenues. Now, because this is a consolidated statement of income rather than like an unconsolidated, it's like you said, it's very, very thin. Oftentimes, what you'll see is with revenues, just below it will be either cost of revenues or if you're like a retailer, distributor, or manufacturer, cost of goods sold. Generally speaking, that's like right below it, and you subtract the revenue from cost of goods sold or cost of revenues, and you get what's called gross margin.
Right.
Oftentimes, for more traditional companies, because accounting's been around for quite some time, that would be again gross margin. It's a way to evaluate a company as far as their efficiency, because when we talk about cost of revenue or cost of goods sold or what have you, that's like what effort was put in, what blood, sweat, and tears was put in to make that revenue happen. But then below gross margin or right after that, cost of goods sold and revenue being equaled out, or the total of that after that would be SG&A, sales. G would be general, A administrative, and M marketing. Google breaks it out, with those two. But there's also R&D, and it's important to note that there was, I want to say it was 2023, somewhere around there. There was a change in the tax treatment of R&D.
Oh yeah.
Like it completely flew past me, but I don't think that change in tax treatment really like mattered that much for like a company like Google. But if you're like a smaller, younger company, that is a nuance that people should be aware of going forward. Maybe the tax code changes. I don't know. I'm not plugged into these things. I'm just aware conceptually
right.
that there's a thing. Yeah. So, anyways, though, like once you take that gross margin or revenue less what we just talked about, you got operating margin. I believe I am correct in that statement.
Yeah. So you're
Yeah.
saying after you take the gross margin,
Yep.
these out, and you go, yeah,
Yeah.
in,
Yeah.
like,
Or income from operations. Yes, in this case.
right.
Yeah. Which again, like in this case for Google, this makes better sense because they're not like they don't have like if they do have a factory, it's not a factory that like really moves the needle because they're so big with other revenue sources and cost centers.
So what's the importance of income from operations versus like net income? Why is that an important distinction?
Yeah, so like it would be a good thing to take note of. Like for example, if you're a software company, you would want to see this might be a more accurate assessment of efficiency because like if you have a really cool top line and you have a very nice gross margin but your income from operations is really pathetically small, then what's going on? Are we possibly overpaying our sales team? Are we possibly overpaying for questionable R&D or marketing, or
Right.
is or our admins like being way overcompensated than
So
profit?
I know a company that's like this.
Yeah. Yeah, so like for the cool thing with the income statement though is like, again, part and whole. And the good thing is generally speaking also we get periodicity to see what's happening. Um,
So yeah, period. I just want to show though to Bacon's
yep.
point about like comparing income to operations compared to let's say gross margin.
Yeah.
I don't know if you know this company, Asana.
I'm aware of them in the past.
Okay. So let's see if I can pull this up.
Yep.
And if we go to their statements, they have is this in here? Yeah.
Yep.
So if you look here,
Yes.
here's revenues, cost of revenues, gross profit.
Yep.
And you can see, I could do the math for you, but it's about a 90% gross margin.
Hmm.
But then look at their operating expenses.
Yeah.
And then they have a loss from operations.
Yes.
So it's like, what's going on? And I mean, you can see like all this sales and marketing and research and development that they're doing.
Yes.
Which we could get into a whole nother thing about how it's kind of concerning if you're spending 400 million on sales and marketing to get an incremental 90 million in revenue.
Yep.
I'd be concerned. But
Yes.
anyways, back to Alphabet.
Yep.
I just want to, go ahead.
Oh, yeah, go ahead.
No, the only thing I was going to do is maybe if you wanted to, we can just walk through kind of breaking this out a little more so that if you're actually analyzing this, you kind of know what you're looking at.
Yeah.
And so what I was going to just do real simple is pull up like an Excel spreadsheet
Hey.
and just kind of show what you're trying to look at here. So I have, just so you know, on my other screen, I just have the Alphabet statement of income.
Yes.
And so here we have revenue, and I'm going to put 257, 627. We don't care. And then we have, I'm just going to do COGS, which is cost of goods sold, which is that's what cost of revenue is.
Yeah. I mean, there almost certainly are nuances between, but conceptually,
Right.
for a beginner perspective,
Mm-hmm.
yeah, I don't think too many people get their heads ripped off for.
So one of the things that you want to do if you're actually building this and trying to understand, okay, how I like to think about it is, okay, now what's the gross profit? So gross profit is
that minus that,
yep.
top line minus that, and
and then we get gross margin, which is just, well, if you want to, I'll be doing the math. I'll just say like the next thing we have, and you can explain it. So gross margin is the percentage, basically your incremental dollar. So for every dollar you sell, you actually get 56% of that goes towards your own bottom line before SG&A. So then SG&A, because I think you said that it's usually sales, general, administrative.
Yep.
So usually how I break it out is I go R&D, which is 31, 562, 9,500, 5, 427. And then we have, and I'm just going to, we'll do 6 because they have it broken out here. sales and marketing.
Yep.
To 292, 26567, 2797, and then G&A. And we have 355, no, 574, 6425. Okay.
Yep.
I'm just stickler for that. Okay, and then how I usually do this
Yes.
is just I'll just say SG and A.
Yep.
Equals the sum of these two. So like this is boring stuff, I know, but I think it helps just understand this a little better.
Yeah.
And so what I do is then what we want to see is what is the operating income, and this should tie out to what they have on their statements.
Yes.
And I'm just going to do this. But so yeah, and
Cool.
just as a quick comparison, yeah, we have 78 million or 78 billion, right? So big. 74 billion, 84 billion. So you see this here.
Yep. And
then we do operating margins.
Margin, yeah. Which
So
that divided by.
If you're looking at a company like this, you really want to look at the operating margins. It tells you a lot about the health of the company, or like a lot of times it tells you what's going on. A good example, just margins are important to look at in general. One of my like bearish takes on Tesla, for example, was I thought their gross margins were going to come down, and that's what's happening. This was back in 2021.
Yeah.
Obviously, this kind of breakout you don't get on their own statements here. Like, and really all we're doing is we're showing percentages, right?
Yeah.
But you kind of need, if you're going to try to do like modeling or forecasting, you kind of want to know what margins are going to be. You can see, okay, they took a dip here. Now they're inflecting back upwards. What's the, so that's kind of stuff you need to know, because you can't really make a model if you don't know what our margin is going to be. What's the growth rate, like putting those together.
Yeah.
But that's why you'll hear people talk about margins all the time, because especially for a company like this, just the smallest change in margins makes a massive difference.
Yes.
So just to think about this, obviously we're working somewhat backwards, but let's say like instead of 84 billion, they made 87 billion. So they have 3 billion extra. It's not a massive change in your margins.
No.
I mean, you went from 27 to 28. If they went back up to the margins here, like this is why people get excited. If I could go back to my 30% margins, like, yeah, we're talking like a massive change in profits. And so that's why it's an important thing, is you can just kind of see, here's what's going on.
And
go ahead.
Yeah, like I know we're called two accountants, one GAAP. And we care about the accounting and yes, financial metrics are very important, but at the same time though, like fairness to people that are more financially inclined or are more entrepreneurial in nature. Like yes, the numbers can look great, but in many industries though, if you're just slashing things constantly,
right,
that's a recipe for disaster in many spaces. Tech namely being one of them. If you're like, oh, I'm going to reduce R&D, goose up my operating income and my operating margins, how long can you really hold your position or possibly grow if you're going to set yourself up for potential disaster, in that you're falling behind your competitors because they're all out there?
Oh, for sure. I mean, if Google wanted to, they could cut this to 0. And I mean, it'll look really good right now. But then it won't take super long where GCP and YouTube and even Google search might fall incredibly. I mean, we're talking about the AI site, all these kind of things will fall incredibly far behind.
Yeah.
So, definitely I agree. Like, we're looking at the numbers so you can understand them.
Yeah.
But in a lot of companies, and we can kind of get into this, especially like growth companies.
Yes.
I'm not going to say financials don't matter, but they matter in a way less, because what you're trying to do is say, what's the story here and like what's going to happen.
Yep.
Aswalth Motorin, who like everyone should know, but like, he's always like, there's two things. There's the spreadsheet side, or like the numbers, and there's the story. And with a growth stock, you really need to know what's the story.
Yes.
He used a good example. A company like Coca-Cola, they're on. He used it like chapters of a book, and he's like, they're on chapter 34 of a 36 chapter book.
Yeah.
You can basically use the numbers to say, here's what's going on with Coke. A stock a lot of people like a Celsius. It is about the numbers to an extent, but it's also about what's the growth story, what's going to happen there. And so it becomes less focused, emphatically on the numbers, and becoming more and more focused on what's the story.
Yeah.
So.
Yep.
Yeah. But anyways, we'll go back to pulling this up. And I just want to show, it's important to understand these are what are going to matter if you're trying to look at a company on a go-forward basis, is looking at these margins, understanding what they mean, and how much that impacts a company moving forward.
Yeah.
When you have revenues this big, just the slightest change in margins makes such a big difference.
Oh yeah. Yeah. And, and yes, like we're more, my majors obviously are more, just accounting and finance. That being said, though, from the years of 2021 to 2023, what happened that may cause these numbers to be interesting? Well, inflation was something that happened, and like that kind of shows itself in both, like, yes, revenues increased. How much of that is due to inflation and to Alphabet's execution? Hard to say, but we can definitely see costs increasing, especially with things that are very, very people based, which would be sales and admin, what have you. So that, like, you don't necessarily want to view things just only in a vacuum, being like, oh well, I want this number to go down, and completely disregard the realities of life.
Oh, for sure. No, you're 100% right.
Yeah. So that's one thing that people should keep in mind. Like I for whatever reason, sometimes will be like, rabble, why did this number go up? And I'm like, oh wait, duh, inflation. Like,
right.
Everybody gets hit. So.
No, exactly. And inflation and just any, yeah. If you have a 15% roughly inflation, I think that's roughly what we came out to from 21 to 23. It's going to impact all your numbers probably.
Oh yeah. Yeah.
And the hope is you can maintain margins. If you maintain margins, then you'll actually end up coming up on top. But anyways, so that's income from ops. And then you have this other income expense in that. What is that?
What I'm gonna assume here is odds are interest related things, as far as like debt instruments. That's my assumption, because generally speaking, like we have our core business related things, core things related to general overhead, and then usually there's some sort of interest expense, or in some cases, interest income, but you're not a financial institution. If you're a bank, it's going to look very different.
Yeah.
Which we'll get into later, I'm sure.
Yeah, because for a bank, interest income is a core business functionality.
Yes.
So this other income is something basically that we're saying is not a core business functionality.
Yeah.
We're saying we sold a piece of property, we made a bunch of money off of it, but like selling property isn't part of being Google, so
yeah.
I'm not gonna worry about that. Or maybe discontinued operations would be in there, right?
I want to say so, yeah. Like probably like also another very common one also is some sort of like currency hedging, or like financial arm of a company. Like, you don't want Alphabet to hire like the best forex traders to goose this thing a little bit higher. Like that's not their business. Like because they're global, you would expect them to hedge the currency, and that hedge to kind of be a drag. Like, and that's fine. You tolerate that because that's just the cost of doing business internationally with different currencies, because you want that revenue source, but just the nature of doing business. At least, that's what I've noticed from a distance with with many companies.
Right.
Yeah.
Well, yeah, I mean, like, just so you understand too, like a good example is they just shut down Google Podcasts.
Yeah.
It was a loss. Like that's not going to be in these, but for 2024, any income that came from that, anything like that, if it had income or loss, would be in there.
Yep.
Because they're saying, hey, there's this product, we canceled it. It's no longer our continuing operations, it's discontinued. And so it's going to be included in other, basically like, and that's why people always focus on income from operations a lot of times, because it takes out a lot of this noise.
Yeah.
Yeah. Like
Yep.
similar to the concept to EBIT. But so then you have just income before income taxes.
Yep.
Which is pretty self-explanatory. You're taking income from operations and other income.
Yep. Netting that out, and then we have or totaling that out, and we have our provision for income taxes, which you'd expect the number because taxes and eventuality, and you got the bottom line or net income.
Right.
Yep.
Now we were talking about this. We have net income, then we have EPS, earnings per share.
Yes.
Earnings per share does not include discontinued operations?
It's not supposed to, like at least generally speaking, because that would fall under the branch of other comprehensive income. Because if we refer back to our balance sheet, which was one of the things that we hinted at tail end of the last episode, was OCI goes straight into retained earnings. That being said, though, like in the case of Google, you don't really care by and large. Like, I mean, yeah, you care. Like if you discontinue something that was a big thing, and all of a sudden it's not, you expect a bit of a hit. But in some companies, if you discontinue a product or shut things down, but the factory or the real estate is worth more dead than alive, metaphorically speaking, that can cause stock price to move a certain way, and not even necessarily show up in the net income or EPS.
Right.
There's that potential.
And you can kind of see it here where in 2021, Google had 76 billion in income.
Yeah.
In 2023, they had 73 billion. But if you look, there's this because 12 billion came from other.
Yeah.
And if you look at the EPS, I know there were some buybacks, but it wasn't enough to make this up.
Yeah.
If you look at the EPS, it's a lot higher here in 2023 because EPS does not factor in this other income.
Yep.
I don't think they had, that would have been, I could be wrong, but like 5.84 minus 5.69. I mean, maybe 3, because, well, no, because you have to factor in the amount that the net income went down. But I don't think this comes into that play on that.
No. Again, generally speaking, is at least when it comes to like an unconsolidated income statement, you would almost certainly see other comprehensive income OCI like down way below.
And it's below the line.
Yep. And in which case, so yeah, we have our net income. Then we have our basic and diluted earnings per share. So we take net income being the top, divided by share count. Now, what would the difference be between basic and diluted EPS?
So basic is just like how many shares are outstanding.
Yep.
Diluted includes, well, there's a couple things it could include. If you have convertible bonds.
Yep.
That includes things that are awarded but not yet like exercised, right?
Yeah, that's what I want to say.
Yeah. So like if I say, hey, Bacon, you've worked at Google, you get an award of 2 billion shares that you can exercise whenever you want. And you haven't exercised it yet, but the award's already been given. Well, that's, I believe, going to come up in diluted net income. I know for sure convertible bonds are, which is a bond. Basically, a convertible bond is I'm going to issue debt. Usually you can get a lower rate on it, which is why companies do it. But you say, I'm going to issue debt that at some point can be converted into stock.
Yes.
And so that's why they consider that. Obviously, Google doesn't have a ton of that. That's impactful to their financials. You can see it doesn't. Some companies, this can change quite a bit because there's a lot of convertible bonds. There's a lot of stock awards out there, things like that.
Yep.
For these guys, no, they're pretty They're pretty. I mean, they're such a big company; they don't need to do a lot of that stuff. And then because they're so big, the stock awards they give out aren't going to be that impactful in terms of net amount of shares.
Mhm.
So yeah, then they have.
Yep. There we go.
Yeah, this is the breakdown here, how they go from. Because this is OCI.
Yep.
So this is where you get. So here's like net income, and then you have all these things like that they're just not going to include in these numbers up here to get EPS. So other income is included in this. Then it's the OCI here. Okay, I thought the OCI was being included in that. So,
Then what could it be instead of OCI? I wonder. Because we got our net income, which I guess. This is why I have a hard time with tech. Like
I would assume there could be a bunch of things. I still think sales of PP&E could be in there, right?
Yeah, that maybe. Yeah.
So that might be the biggest one.
Mm-hmm.
I'm not sure. But this basically, so the way a company looks at it, it says, there's our net income.
Yep.
Here's all this stuff. And that's why you have never heard a single person talk about comprehensive income. Ever. But basically it's just a bunch of ancillary things, like you said, foreign currency, change in net unrealized gains. So like if they own stock, reclassification. Yeah. So it's mostly like change in their available for sale securities, which basically means like, for example, I know Alphabet owns a bunch of GitLab. Is it GitLab?
That's what I want to say. Yeah.
GTLB stock. Yeah. So they have a big share in GitLab. So as GitLab goes up and down, you're going to see them there. Another example would be Amazon with Rivian. I know Amazon has a big stake in Rivian. So Rivian goes up and down. That hits there. Although because their stake is so large, it might actually go, because I think if you have above 20% of a company, then the accounting's a little different.
Yeah.
You can go equity method. But if they've sold it off, I know, for example, Ford would have their Rivian stake be in here. But yeah, like, because no one cares about cash flow hedges, change in foreign currency translation, available for sale securities. All these things are kind of noise. And so I think rightfully so, they just kind of don't worry about them.
Yeah, because it's not core part of the business. Like you'd expect some moments for it to be a drag, and other cases, like rare moments, maybe something cool. But
right. So one of the things that we'll say, or we can talk about a little bit, is this is like very little information that you get here.
Very.
So if you're trying to understand a company, you want to know what are the big businesses, because like, for example, Google, you have Google Search, you have Google Cloud, you have YouTube, you have their like material stuff like Android. So usually if you're looking at a 10K, you can't stop here. If you want to understand a company, you need to drill down into the notes. And we'll just go through this really quick because they're going to have like disaggregated revenues, things like that. So that's why the notes are really important. And if we go down, disaggregated revenues. And this is kind of where you see everything broken out. Well, at least by business entity. So you have Google Search here, YouTube Ads, Google Network, which is like their sell side platform. I don't think DoubleClick's in there. It's primarily like any money they make off of like Gmail, Google Sheets, stuff like that's going to be in there.
Yep.
And that's so then they summarize that as Google advertising, and they have the Google subscriptions, Google services, and Google Cloud, other bets, etc.
Yep.
So this gives you a little more of a breakdown, and as you can see, total revenues, this ties to the comprehensive income. And they even break it up by
geography.
Yeah. And like, so if you want to understand a business and be able to like for example, and if you've ever seen my models, usually what I try to do is break things out by business segment.
Yes.
And you want to break out the margins by that big business segment. Going back to like margins being a lot, it's important if you're trying to understand this and say like, okay, so Google Search has 70% gross margins, but Google Network has 5%. Well, if you're looking, and this is a hypothetical, but if you're looking and all the margins or all the growth is coming from Google Network,
Yep.
that's going to decrease margins. So then like it's going to impact the business differently.
Certainly.
Yeah. So you want to understand that stuff too.
Yeah.
And often geography comes into play with that too. Some geographies have more margin, more revenue than others.
Mhm.
Yeah. This is, by the way, when you're looking at these cloud guys, this footnote right here, revenue backlog, it's one of the first footnotes I always check whenever I look at them. You kind of have to take this backlog growth combined with their Google Cloud revenue to get a true picture of what's going on. Because you can see here they have 74 billion remaining performance obligations, which basically means monies they've signed, but haven't actually recognized as revenue yet, or contracts signed. And so you always want to see how that's growing, because that's going to tell you how future revenue growth will go for the business generally for cloud providers.
Yeah, like, and it's one thing, like, because a single $1 billion is almost relatively insignificant to Google. Like, yeah, they'll care if $1 billion goes missing, but is it the end of the world for them? No. That being said, like, in a vacuum, like $1 billion of anything is a lot, generally speaking. So like yes, I personally am a generally skeptical person. With everything, to include myself. But like, if a company has a reliable backlog and they see this backlog, that's why when the management team gives projections and they know they have a backlog, they're usually basing it off something. I mean, it's like assuming that they're credible, good actors, and in which case, like, hey, maybe there is legitimacy to some sort of growth story or margin expansion, because they're able to see this sort of thing where we'd be like, well, how are you able to project like just shy of $75 billion? That's it's huge, it's massive, it is. But again, like, when you have that many customers and that much money moving around, like,
and for people that know me, they know that I hate Google's management, but when I see things like Google Cloud, this was one of the things I got really excited about. So I'm going to pull Google's Q3. So this is a Q4 report. On their Q3 report, if you pull the same thing, and this is where you see the real growth. So like, okay, 3 months, because we'll just look on a quarter over quarter basis. I don't know if they haven't broken out here. I'd have to go to the earnings. But it grew quite a bit. So, but we can see here in Q3, they did about, well, actually, we could just do the math from 23, 30. So they did about 10 billion. So they went from 8.4 billion to roughly 10 billion in top line revenue for Google Cloud. But then also in Q3, their backlog was 6.549, so 6.5 billion. And that grew all the way to 7.4 billion. So like, you're seeing this massive growth. So you're seeing, like, not only are they growing top line, but their backlog contracts that basically tells you how many contracts they're signing. It's growing really fast too. Which is an exciting thing. And so we'll, like, as we go through this channel, we'll get more and more into these things. And maybe if people ask questions, things they want to know, we can dive into them. But this is why, like, I think especially if you're getting into this, you try to understand things. You want to know a company, why reading 10Ks are, like, important. Like, it can be annoying. Like, I read all of my companies that I own their 10Ks. I don't always go through all the 10Ks just because of time, but definitely at least 10Ks. Because there's a lot of information in there that's relevant. You'll find things like who their main competition is, what management thinks, are potential hurdles in the future, what their primary opportunities are, things like that. And you kind of understand better breakdowns as you go through things like this. So I think that's something that's really important to understand. So, but yeah, very brief overview though of the income statement. There's a lot of things in there, when it comes to modeling. Like I said, you want to know really what are the gross margins, where are they going, what's the operating margins, where are they going. If you're a company that has a lot of potential depreciation capex, as we get in the cash flow statement, you want to see where those are going.
Like, and it's another thing also though. Like we all bring our own biases and thought
Mhm.
processes to companies, but like say for example Amazon, people might look at the margins and the numbers of them, like, and how they've grown and changed over time. Like 20 teens, I remember it was very very popular to be like, oh well, Amazon's just a retailer. Why are they at such a premium compared to say a Target or a Walmart?
Yeah.
Harumph, grumble grumble. But like we got to like consider, well, what's the revenue streams and sources there? Like Amazon rolled out a subscription model around
Mhm.
that time. They also built their own hyperscaler.
Right. Which
Like, yeah.
that was
So how many WalMarts, Targets, and Costco's have their own freaking hyperscalers? Like,
not many.
yeah, like so, like businesses definitely can and do change. In which case, sometimes the previous numbers and margins just aren't comparable, even within the same company. And like there's a bit of an art to this besides the accounting. Like the accounting, hopefully, will help people not lose their shirt necessarily, but not a grounds to necessarily like short a company because
Oh, for sure.
oh yeah, like Amazon's at a premium relative to what we think are its peers, and no, the business has
Oh,
changed.
and it turns out their peers were not
No,
Target.
no.
Uh,
So
so,
it's
and that's the thing is like financials tell part of the story.
yeah, like it's another thing entirely to like really consider. Well, where's this R&D going? Like if it's R&D that's going into something that has legitimacy, then great, that we got something to work with. And there's also the real possibility that this R&D is literally getting thrown into a fire. What the hell are we doing here?
Yeah. Oh yeah. Like it's like I said, there's a lot of things where I look at like R&D or like the sales and marketing, like that one for Asana.
Yeah.
We're like, why are you spending this much sales and marketing to get like a tiny amount of incremental revenue?
Yeah.
It might tell you something bad is going on with the company. Maybe the company's not got that great of a product, or maybe the product's kind of almost commoditized and not a differentiated.
Oh yeah.
You know, they're basically giving away the product at that point to grow it. So
Yeah. So I really feel embarrassed actually that I messed up the OCI part, like because with the consolidated income statement we had that other income.
I thought that
It,
was I didn't realize there was a page
yeah,
below.
it was
But,
probably just the interest
but
related.
I was right; it was
Yeah,
below the line. I was like, oh,
yeah,
normally it's
yeah,
below the line, and I was
yeah,
like, oh,
yeah,
that's good.
yep,
So did get that part right,
yep,
but
yep. We got there eventually, everybody.
but
Um,
nah, it's fine.
yeah. Any other unresolved issues that you want to talk about with the income statement, or in this case, statement of income?
No, I
Okay.
think it really just comes down to like we said, this is a tool, and you have to know how to use that tool. So
Yeah.
when you're investing in companies, you're trying to look at what's going to happen in the future,
Hmm.
and so using these historical numbers to find out. I really think you come down to because what's the revenue growth rate?
Yeah.
Eventually, like, and I have no problem. Eventually, we can do a stream where I just do like a model on
Oh
here.
yeah.
We
Yeah.
walk through the stuff. Or I should say we do a model. Maybe we can just do like a Google Sheets and we're both in there like but you want to be able to with confidence say, hey, this based off these growth numbers, here's how they're going to hit these margins
Hmm.
or these numbers, these income numbers. And you're gonna do that by understanding margins. And I think a lot of people don't get like I see a lot of YouTube finance and a lot of these they like sometimes do models and it's so obvious they have no idea what they're doing.
Yeah. Yeah.
They just usually their models involve very heavily multiple expansion. So like going from being valued at a 10 PE to a 30 PE. Any company that does that, yeah, it's going to be a winner for you if that happens.
Yeah.
And so that's why it's a meme in our group that says just slap a 30 PE on it.
There are things, by the way, just for like the viewer base behind the scenes, like that we've collaborated already on future topics. Like we still have the statement of cash flow.
Yeah.
Uh,
Mm-hmm.
so like we'll get a lot of like the core fundamental basics done and over with, but like people have been nice enough to say, hey, like really interested in joint venture accounting. That's on the radar.
Oh, joint
Yeah,
venture. That's right. Yeah, we
yeah.
have
So
one. It's
yeah,
about 10 things, 12 things long, just of things that we're
Yeah,
pumping out.
yeah. Like, and we have our own things that we have organically. So like, trust me, everybody. Like, thank you for being patient. We still have one more thing to go through,
Well,
which would be the next one. But
and you need these building blocks because, like,
yeah,
if you just
yeah.
jump into like, here's joint venture accounting,
Counting, yeah, it's like the heck.
or like, what were the other things that we had talked about? Like, if we get into like revenue rec or like, doubtful accounts recognition, all those kind of things. If you don't even understand, like, well, what's AR, what's revenue, like what's the, then you have a hard time going from there. So I think it's important to have building blocks before you got to walk before you can run.
Yeah, yeah. So yeah, just to I guess put a nice bow on on the income statement. This is the accounting basis, the accrual basis of accounting. With revenue recognition fundamentals, you recognize a revenue or sale once the performance obligation is met. Generally speaking, expenses are recognized as they're incurred with GAAP accounting. IFRS, their conceptual framework is more neutral rather than GAAP's conservatism principle. So that there is difference and nuance there. We're just purely talking about GAAP accounting in Google's case or Alphabet's case. This is very appropriate and relevant. Yeah. Yeah. So that there will be a difference, obviously, between income statement and cash flow. You'd expect that.
Oh yeah. No, there's a very large. I mean, we can just glance at the statement of cash flows right now, real quick.
Yeah.
You can see all these extra lines. I mean, you're talking about like look how much. I mean, it's larger here. There's
all the adjustments,
stock-based, and so we'll go through what this all means and how it relates. So if you don't understand the balance sheet and what accounts receivable is, you're not going to understand why this line's here.
Yeah.
You're not going to understand, well, why is this? How do you just get net income on a cash flow statement? Well, you get that from the income statement.
Yeah.
You work it from there. So understanding it's kind of there's a reason for us going through it like this.
Yeah.
So you can kind of step back and go, oh, okay, that makes sense. Because for almost every company that reports, they do the indirect method for cash flows, which means it builds off of your income statement.
Yes.
And so in fact, I don't know if I've ever seen a company doing direct method, but
I don't either, honestly, which worries me. Because like maybe that makes me wonder if I missed something. But yeah. Shoot, I'm trying to think of if there's anything else. Like, are there any other like footnotes that stand out to you when it comes to
footnotes?
Yeah.
Oh,
or like, glancing at them, I guess.
Well, do you want to talk about revenue recognition? Like, that's a big one.
Yeah.
For Google, it's really simple. So so revenue recognition, that's something you want to look at. If you're an accountant, at some point in your career, as you're climbing, you're going to apply for jobs, and they're going to ask for one of two things, if not both. They're going to say, do you know what's called ASC 606 or ASC 842? Every single, and I don't know why they have to put it like that when they can just say, do you know revenue recognition and do you know lease accounting? But those are two things. If you climb up as an accountant, at some point you're going to get somewhere like ASC 606, which is Accounting Standards Code 606. That one is revenue rec. 842 is lease accounting. And so, but anyways, so the revenue recognition.
Yep.
When you're on the accrual basis, you basically recognize revenues when they're earned.
Yep.
Cash basis, you're going to recognize it when it's paid. We can. Oh, I would love. No, we're going to save revenue rec, and we're going to go through MPW. That's a whole separate episode because that is a fun episode. Going through MPW's conversion from. We'll give a teaser.
Yay!
Investor relations.
This is my value add, by the way, people. I am still the -2 accountants, whereas Andrew is worth 4.
No. So this is their. We'll just say. We will explain how you get a negative total revenue. This company has negative revenues. And so we will explain in revenue recognition how that happens. And it's a really fun episode. That's why I'm excited for that. I was like, oh my, I saw this and I was like, this is going to be so fun looking at negative revenues in a quarter. And
How is that possible?
my initial thought was like mostly right, but like I didn't get the exact thing because I didn't think you're allowed to do what they did, but I guess you can.
Yeah.
So, but basically revenue recognition tells you when you can say we earned revenue, and when you say you can't. Like simple example, and then we'll go on, and we'll so this is just the last teaser. As I work for a nonprofit, and the CFO before me decided we recognize because we get grants, and he would say, the second the money comes in from the grant, it's all recognized as revenue. And so when I got here, I was like, well, that's not right, because what happens if we get a grant and we get $50,000 to feed the homeless, but we don't actually use it for that? Well, then the grant companies will come back and be like, give us our money back. We didn't actually earn money for that grant. And so we recognize it as we use the funds. And then we recognize it as revenue. Similar, you're a construction company, someone pays you money up front. You don't recognize the revenue until you actually build the house. But we'll get revenue recognition. We'll do a deep dive on that because that's a really fun topic.
Yeah.
And there's tons of different things on it. So that's about all I have. But yeah, we'll have cash flow coming up next.
Yep.
Is what everyone cares about, right? Income, cash flow.
I mean, like, when did you want to do ratios by chance? Like, besides like gross and operating? Because
we could do that after we get through financials.
Yeah, like anecdotally, like one of the things is like when it comes to gross and operating margins, very important. Like, but by and large, you can either like use it in a vacuum within the company itself. In some cases, so long as the business model hasn't changed too much, you can compare the company to its previous, whatever quarter, year, what have you. But I like with some companies, I like what's called inventory turnover ratio.
Yep.
Where you would take cost of goods sold divided by the change in inventory. So it depends on the period of C in question. That's another metric of a relative efficiency. But by itself, you got an inventory turnover ratio that tells you nothing.
Right.
Because you want to compare that with like, some sort of
Industry.
operating or, like gross margin and with peers. Yes. Yeah.
Right. Because like inventory turnover is really fun. And actually, I know a story of a company that went bankrupt because of inventory. No, that was DSO. Their day sales outstanding.
Oh, very nice.
We can get a lot of these. I'll give you a little teaser. But so basically, there's a company that I had a friend who audited. And what happened was they ended up declaring bankruptcy because they got a big contract with the government. One of the things you learn is a deal with the government is awesome, but it's also comes with some conditions. So one of the things is the government's not going to pay you so most people will pay you 30 days from when you build the invoice. Government, you'll be lucky to get a net 90 to get paid 90 days. And so what they didn't build that into their factoring that in when they were planning everything out. So they actually couldn't meet their debt obligations because the money hadn't come in from the government yet. And you're not going to get the government to send you that money early. And so what happened was because of their cash conversion cycle versus their money going out cycle, they ended up going bankrupt. One of the first things I did when I came here as a finance officer was say, okay, we basically have like a bathtub, and we have the water, turning it on is the money coming in.
Yep.
And are we plugging the hole, or are we just like opening it up and letting the money all flow out? When I got here, it was like we decided that we had weren't going to collect money from everyone just because. And so like the faucet wasn't turned on fully. And then we just had like a gaping hole with no plug in it for the money going out. And so like I literally just met with like people and was like, this is our situation. Like we have a bathtub that's just like trickling in and all of the water is going away and we're never gonna be able to take a bath. So like let's figure this out. Let's be able to like clean this up. And we did. But like so very important in the accounting cycle. And so like understand these things will help you understand how these businesses are operating, how they run. Will it maybe make you find a 10x company? No. But maybe if you're looking more at like deep value, it might like with a company that's like a manufacturer trading at like a 3 PE because people think it's going to go bankrupt, and then you have to dive and know these things.
Yeah, a lot of diving because that means that this is an ugly business.
Yes.
Yeah. Plenty of ways to make and lose money in a market for sure.
Oh, yeah. But no, I mean that's all I have. But I think there's a lot of topics. I mean, dude, I'm not worried about. We'll have content coming out on a weekly basis for a while.
Yep, certainly.
Oh yeah.
Yeah. So yeah, I think we got a fair amount of teasing as far as future stuff for viewers to look forward to. Anything else you wanted to cover?
No.
Nope. Alrighty. On that note, I guess we can end this thing.
When statement Dex is asking when statement of shareholder equity. I'm sorry, Dex. We will have my favorite financial statement at some point.
Yeah.
But yeah. Anyways, with that, thanks everyone for joining. If you want, like and subscribe. And if you have any questions on anything you want us to cover, feel free to leave a comment.
Oh yeah.
That said, we'll be signing out. Have a good one.